No. There we go. What's up, everybody? What's going on with the Outliers? That was a little tricky. Getting this thing turned on happens every once in a while, but we are here and we are kicking off episode 9 of Outlier Options Trading Basics. This is a series that I periodically do throughout the year, and we go back to grassroots. We start from the absolute basics and work through from ground zero. The whole point is to invite new traders into the space, but hopefully send them down a healthier path than what we typically see on the internet, which is more stuff like make $5,000 on 99 cents every day for the rest of your life, easy in 2 seconds. I think I got it all on that one. That's a pretty common one. And then it's also for the more seasoned traders to just take a closer look at the fundamentals. That's actually one of the primary reasons why I enjoy this series a lot, is because I've been in the markets now for over 18 years, but going through and revisiting the basics, as simplistic as it can seem sometimes, it really is valuable. So that's what we're here to do. Now, of note, we are coming to an end for the series. So if we go through this really quick, got to slide it over so I can see, you'll see that we are literally in the second to last session. We have only 2 left after this one. So I cannot encourage you enough to make sure you're maximizing the experience for what it is. The reality is there is not a lot of great, free, accessible options education out there. It's just not a thing. If you get free education from a broker, more often than not, there is a baked-in incentive because they want you to trade more with more legs. It's how they make money. Now, that's not to say that there's nothing to be learned or that that kind of education is completely worthless. That's not the case at all. You can still learn quite a lot from there. But the just fact of the matter is most of these places are going to have some sort of skew that you have to pay attention to. So the session for today is going to be kind of pivoting now. We've gone through a lot of basics. We've talked about how to read and analyze options chains, what the Greeks are, volatility, being organized as a trader, how options are priced, buying options versus selling options. We've covered pretty much all there is with respect to in a deeper 101 level. Now, the reason why it's a deeper 101 level is because you can see the Options 101 series that I have on the YouTube channel, right? So we didn't have to rehash from the very basics, but we did a recap. Now, the goal for the session today is to start pivoting us into being able to successfully paper trade. Now, notice how I say paper trade, because for most traders going through this 10 episode, 11 episode series on top of watching a handful of YouTube videos, that ain't it. Like that is, you're not going to learn something fast enough to be effective at it in that way. And you have got to be comfortable with that as a trader, because if you are so focused on trying to get started as fast as you possibly can, literally the only thing you're inviting is losing your money. And it's straight up hypocritical for me to say this, because like all of us, that is exactly how I started. But the problem is that if you can't mature, at least at some point in your journey, and identify that condition, you are going to fall into that broader loss statistic, which is pretty profound. I research it regularly to see if there's any new research that comes out related to the success rate of traders in different capacities. But there's not really a lot of great research on traders from the options trading capacity. It's all bucketed, right? It's like day traders, it's everything in one. And that's a really low probability. I would argue as soon as you enter the world of options, you've now just added complexity. And I believe that the failure rate would actually go up due to that complexity. I actually have a video that I recently made. I don't know exactly when it's going to come out, but it talks about this idea of being right but wrong as an options trader, which happens all the time. And that's due to the complexity, meaning your idea might have played out how you thought it might. But because of the way we set up our positions, we end up losing money anyways, even though the idea panned out. That happens a lot. So all that stuff aside, let's say hello to everybody. We got Paulo, Shamgar, Ben, Reese. Good to see a bunch of familiar names. That's also really cool, seeing people that have really stuck through the series, right? Like this has been, again, this is week 9, And there are a lot of familiar names in the chat, which is super cool because there's an element that's disenfranchising for a lot of people. If you think about the number of people that were on the first couple live streams for this, it was literally over 50. And the attrition that I see doesn't surprise me at all. I've seen this my whole life in most things that I do, to be honest. It's not even related to trading. Same thing in the Marine Corps, right? Like if you go through OCS, all of a sudden you see people shedding left and right because they cannot get through the program, or same thing at TBS. It happens in life where we have this rosy idea of what something might look like and we start it. And then we start realizing that there's a little bit of a grind to it, like anything that you want to get good at. And then you see the weak hands fall off, as it should be. And that's not to say that those people, they're worse than anybody else. It just means this isn't for them. And that's the case for a lot of people with a lot of things. But it is very cool to see the people that persist. And again, it's not easy. So proud of you guys for sticking it out because it's no joke. All right, so let's get over and let's start with a quiz. First thing, what is the difference between open interest and volume in the context of options? Doesn't really matter if we're talking about it at the aggregate level or if we're talking about it for an individual option or a specific term. Doesn't matter. Just the functional difference between open interest, aka OI, and volume. Feel free to throw your answer in the chat. We'll take a look, see what you think the correct response is. I imagine most of you will be familiar with it. H says OI is the total number of open contracts. Volume, number traded hands today. Yeah, I think that's good. I think that's a good overview. Now, a couple other notes to build on to that. Pork says liquidity. It's not liquidity. It can definitely represent a level of liquidity, but open interest simply represents the number of existing contracts. So if we take a look at SPY and we take a look at the options chain and we go all the way down here to the bottom, you'll see that there's open interest. And that looks exceedingly low. I do not believe that that's correct. That seems much more correct. So the open interest right now for SPY on the call side is 6.5 million. And on the put side, it's 11.9 million. Those are the number of contracts that exist today and currently are open, meaning there are two parties to that trade that are choosing to maintain their position. Now, volume represents the number of contracts traded, and we can look at volume over different time frames. We can look at volume today. We can look at option volume over a rolling 5-day period to assess if something's becoming more active, and so on and so forth. Volume doesn't differentiate whether or not it's an opening or closing position. So of this 5.8 million calls that were traded today, we do not yet know how many of those are opening positions versus closing positions. We will see that reflected tomorrow. Open interest updates overnight, and then the next day, it will not change all day. Open interest will be whatever it is all day, regardless of how much volume there is. And then once we see where that volume goes throughout the day, then the next day, it will update. So open interest essentially updates overnight, and then it's static during the day. Volume is essentially the inverse. It's going to move all day as people are trading, but then overnight, there's not going to be volume. It's going to zero out, and then it'll open back up the next day. The reason why we need to know the difference between these two things is because they mean different things. And the way that we might use them for information, shocker, is different. Next question. How can we use volume over OI? So this essentially creates a ratio. And for those that are a little, more visual while you're answering that, I'll show you right now. We'll go into a specific options chain I'm going to go further out in time because it'll be lighter. It won't be as much. It'll be easier to show you. let's do this one. I think this is a good example. So in this option chain, and for this option specific, let me click it so that you can see the one I'm looking at. We are eyeballing this bad boy. And then I think yellow will be visible. So let's take a look. So we can see that the volume right now is 317 volume. Open interest currently is 159. So we can create a ratio. We can say volume over open interest. So in this case, it'd be 317 divided by 159. And then this equals around 2, which is what this is tracking. Does the math for me, because math for Marines. We're dumb. Now, what this can be used for is, let's see, Reese says, how do you check weekly volume? I always looked at daily. I'll get to that in a second. H says to show how much activity is happening in the period versus the total activity in a contract has traded. That's correct. So expand on that a little bit more. So it's assessing the recent activity compared to the existing preceding activity. Completely correct. Now take that one step further. How do we use that information? And then in the meantime, for Reese, you essentially can either track it yourself or you have to find a data source. So a platform like Thinkorswim, I don't think it actually is in this platform, but platforms like Bar Chart, Unusual Whales, again, as you guys know, I'm affiliate for both of those. They do have that information, and you can also track it for yourself. ORATs will also have it. So Ben says estimate OI. Nope, that's not it. Good guess. Let me phrase it to you this way. Let's say that we're looking at a toy. Let's look at a toy, whatever the toy is. And let's say that you're in the field of flipping toys. You try to find toys that are cheaper and then sell them when they're more expensive. So let's say that there's this toy right here, which I call it Stickman. And Stickman, historically, shockingly, really not that popular. The current open interest on the number of Stickmen that have been purchased has been 5. And then Stickman starts doing marketing. They're doing a limited production run, so on and so forth. And then all of a sudden in an individual day, we see volume for Stickman go to 100. So if we have 100 volume over the existing open interest of 5, you can do the math here. But this tells us something very interesting is going on. It tells us that the preceding interest in Stickman was 5 interest units. Then all of a sudden there's 100 interest units in Stickman. Why would there be so many new interest units in Stickman? Could be for a lot of different reasons, but it tells us something very, very specific. Supply and demand relationship is changing a little bit, and demand for this specific thing is much higher. This is how we use volume over OI as options traders. Just sub out this very cool Stickman and think of it in terms of an individual option. Now, the Stickman example is obviously simplified. We're effectively saying the reason why people might be growing interest in Stickman, it is very simple. It simply means more people want this toy for either they want to bid it up and then sell it. They want to keep it as a collector's item, whatever, right? There's not that many reasons why ultimately people want an increase in Stickman. You can break down that demand pretty easily. It might just be a really hot toy for this Christmas. Whereas options, sticking with the standard theme, very complex. There can be a lot of different reasons why there's more interest in this specific options contract versus other options contracts. But what I can tell you is that if I clear this stuff out of the way, notice the color of this column, right? I made this thing script to make it easy to eyeball stuff here. And then I'm just going to click down here so that it doesn't shade otherwise. And then notice right here. There is interest in these two options, the 730s and the 735s. There's abnormal interest in these options. Now, you have to understand the relative component of options. Because in this case, for this example, there's obviously elevated interest in these options. But for something like SPY, this really isn't much, right? We're talking 300 here, 1300 here. The total dollar value of that interest, quote unquote, is not very high. So this isn't anything that I would think very much about. But this idea becomes much more interesting as you're trading other kinds of names that show anomalous behavior. I actually gave a couple examples of this recently with VIX. And it's honestly one of the reasons why I was so well positioned for these drops is because the VIX had very unusual options trading behavior leading into the drop. So that is why volume over OI is of interest to you. It's a very usable tool. Okay, so that's your quiz. Let's jump into, obviously, quick recap now. We talked about how to use the Greeks to build trades and where to find the Greeks. Again, the last session was about navigating the options chain. So this is essentially how we visualize the Greeks for different options to come up with ideas on how we could conceivably create a trade that reflects our ideas. The other things that we discuss are how to analyze an options chain, because there's a lot of data. I gave you just one example right now of volume over OI. But we talked about also how to glean information from volatility, from volume behavior, from term structure, from call put differences, both in terms of volatility, but then also in terms of overall volume. We talked about how to detect if options are being bought or sold. All of these tools amplify the total amount of information you have at your disposal to make better trading decisions. And all of that is literally captured in the options chain, which is super cool. It's like a one-stop shop for tons of information. Okay, so now recap complete. We get into the session for today. And the session for today is all about how to build a trade. Now, for this, there are two reference videos, which I honestly imagine most of you, I hope, have seen these videos. If not, then actually a lot of this is going to be a little bit difficult to follow because I don't intend to go through these videos in crazy depth, again, because they're already here in videos. But there's the first one. That's the outlier strategy process. And then here's the second one, which is the outlier trade process. And again, I call it those names just because it's the way I think about it. But this isn't necessarily the way to do things. This is a way to do things. But one of the most important things to keep in mind, and I want to emphasize a term that you see on your screen here, repeatable. This term here is super important. Why do I emphasize the point of repeatable so much? Why am I asking you this question? If you know why I care so much about a repeatable process, throw it in the chat. And the reason why we need to take a minute to discuss this is because this effectively, at a high level, will be the total representation of your capacity as a trader, is how well you can execute a repeatable task. So why is repeatable so important? Why does that matter? Ben says it's hard to collect clean data when your input is random. Good, go further. That's exactly correct. H says to make a system that's profitable rather than getting lucky, and then ultimately getting wrecked at some point. Bingo. Honestly, between Ben and H, those responses in line exactly as they're written is the reason. It's because when we're trading options, we're already trading. Think of it this way. If you think of the stock market as a whole is wildly complex. This is about the most simplified version of the stock market that I could possibly create to even give you a glimpse of what is in here. This doesn't even go into, there's a whole other bucket over here that I didn't add because this was originally a 101's version and I didn't want to overwhelm people. But effectively, I don't know why I can't. Thank you. Effectively, I will add another one here that a lot of you might not even be familiar with. Exotics. These are not things like you're used to seeing. So these can be things like custom swaps. This can be Bermudian options. I'm just going to put Bermuda op. Damn it. It's just a little. My OC will literally not allow that to happen. So we'll have to do exotic options. We'll have to use the same term twice, which is awful to do, but it's a necessary evil. But there is this exact thing where the market itself is very, very complex. It is nowhere near as simple as people tend to think it is. And that's because we tend to think it's so simple because Robinhood wants to make it seem that way, right? To get you to trade because it's how they make money. But if you as the trader are interfacing with this really complex place, there's a bunch of different exchanges, a bunch of different participants trying to do all sorts of different things, trading these different kinds of securities with different time frames, that all of these things are essentially big information ingestion sources for quite literally the world around you. The conversations between Trump and China regarding the tariffs will impact the market. The conversations between Putin and Ukraine, Zelensky, will impact the market, and so on and so forth. So if we go back to the purpose behind this concept of repeatable, it's because the system that you're interfacing with naturally is exceedingly complex. If you, as a trader, cannot differentiate between the output of your system deriving from luck or path versus the actual performance of the system and you as a trader, sooner or later, it will show you. And this is the exactly, funny enough, I wasn't expecting to use it for this example, but this is exactly why if you scroll through Reddit today, you are going to see a ton of these. Lost it all. Down over 8K trading options on this. If you literally just, they got assigned target calls early, it looked like they actually did okay. But this person lost 80K in the stock market, right? Like the point that I'm making is right now, they learned their lesson today. Right now, there are droves of people that are getting humbled by the market. And it's because the market is finally showing another phase that people are not used to seeing. If we look at the total market performance and the market in general, it does absolutely tend to go up. If I zoom this out far enough, you'll see that reflected. It tends to go up. But there are nasty periods where it can go down pretty aggressively. This is the COVID drop. This is the bear market that we had in 22, where the market was down about 19.4% over the year. These aren't even really the quote unquote very ugly parts. The real ugly parts are back here in 2008, 2009. And then we have to go back way further into the 1930s before this was around. but there are plenty of periods where the market has shown really, really rough times. And this is also why a lot of traders get really confused between how well things are working versus the reality of markets. I had somebody that I was on a coaching call with, just walking through their process and their approach, and they were talking about how they were crushing trading 0 DTE options. And I'll show you exactly what they're doing. Because to no surprise, it didn't work that well for too long. So effectively what they're doing is, I'm going to use the 3 DTE options just because the 0 DTEs are going to have absolutely nothing, right? Because it's after the close. But I want you to see the general construct. So effectively, what this person was doing is saying, where do I think SPX is just overwhelmingly likely not going to go? And they would go all the way out here to what we refer to as the tails. We come all the way out here to a 4 delta option, a 2 delta option. If you take a look at the probability of a 2 delta option, or in this case, a 3 delta option being in the money at expiration, it is 3.2%. If you take a look at the probability of a touch, it is 6.3%. That is a exceedingly low probability of occurring. What was happening is that they had a massive string of winning trades. As you would expect, most of these trades worked, and it's because the probability favors it. The issue was, over the course of 2 days, they gave back effectively all that they made over about 6 months. This is the misunderstanding of how to build a trade that's based on a sound approach. So let's now talk about that. In order to even begin this process, we have to understand what we are trying to do as a trader. And in the options trading world, in my opinion, it starts with this. It starts with creating an approach. So this is the construct I give you to give you some structure around how to create your own trading approach. And again, I fully encourage you to rip this and then turn it into your own version. Do what works for you. This is what works for me. The way that I approach the markets is by first analyzing market effects. I refer to them as profit mechanisms. These market effects, profit mechanisms, are the underlying method in which we attempt to make money. This sounds so simple when you break it down this way. But if I go through most of the people, and just in the Discord that pop on the live streams that are even just in my broader viewership, if I go through most people and I say, show me your last 10 trades, and we look at those trades together, I can literally guarantee you I will find the overwhelming majority will have trades that are suboptimally structured against what they are attempting to trade. Why would that be? It's because we're not starting from this step. What most traders mistakenly do is they start by putting the cart so far in front of the horse, you cannot even see it. What most traders do is literally not bother with any of this, completely skip this entire stage, and instead they jump straight into the second part of this broader process, and specifically this step right here. If we talk to most options traders, this is literally the only thing they're doing. The only thing they're doing. So my goal for you all today is to understand the importance of this step, and then how, once this step is built, how it simplifies this process so much. The reality for you as a trader, and I can unequivocally tell you this has been my experience, the process of actually trading is mind-numbingly easy. It's mind-numbingly easy. There's effectively very little thought that has to go into things. And that's the process of actually clicking the buttons. It's so easy. And this is the funny part when most people say, well, like, how much time do you actually spend trading? And it's so small. Well, that too, but it's such an insignificant amount of time. And the reason why is because all the work is done before you ever place a trade. So when we're talking about this idea of building a trade, the entire premise is that we have to start by doing all of this work. Otherwise, your trade, whatever you're doing, is going to fail. That is the reality you have to accept. If you don't like that, too fucking bad. What we want, what we prefer, what would be easier for us doesn't matter in the least. What matters is what can we perform in the long run as a trader. So looking at this entire thing, I'm going to breeze through this. But first thing, I want to open up a poll. And I'm actually genuinely very curious in your response here. Let's take a look at SPY. Actually, I'm not going to do a poll because I want to ask a few questions back to back, but there will be short answers. So you should be able to run through them really quick. Let me pop the door for Thor real fast. About time for him to get his grub on. So the first question, if you wanted to trade SPY right now, let's say you had to put on a trade in SPY right now, are you going to trade it up or are you going to trade it down? Just literally write up or down. We're going to start with good old up or down analysis. And you'll see where I'm going to go with this in a second. Alberto says down. Let's see what else we got. Ben also says down. Who else? Who else is brave to figure out how they want to trade SPY as it sits today? Hater says down. H says up. Reese says no sideways. That's correct. No sideways. Up or down. Those are the two choices in this scenario. Down. Okay. Next question. And I'm specifically interested in the people that answered the first question. What time frame would you want to trade it up or down? Would you trade it for a day, 5 days, 10 days, a month? This is in the context of whatever direction you chose to pick. So for this answer, you literally can just say X days, X week, X months, whatever. What duration? Reese says 5 to 14. Roto says 2 weeks to a month. H says 1 to 5. Ben says 1. Hater, you answered in the last one. Where are you at? Few weeks, okay. 1 month from Paulo, okay. Jamie, what about you? Shamgard jumping in, down 2 to 3 months. Jamie says 2 weeks. Okay, so far, what do we notice? We notice that every single one of us looking at the same thing, even though there's overlapping ideas in terms of direction. A lot of people said down, still some said up. But then as soon as we add another layer of duration, there's some overlap, but there's also more different answers so far, right? Next question. This is, again, agnostic to what days to expiration you would pick. I simply want to know, what kind of option would you trade? Would you buy or sell calls or puts? Don't worry about strike. Don't worry about any of the Greeks. Don't worry about what expiration. just based on your idea and your time frame. Would you buy or sell calls or puts? So there's two parts to your response: buy or sell, calls or puts. What is it for you guys? I see buy put. I see sell calls for Reese, Hater. What else for the rest of you guys? Alberto, H, Paulo. Ben would buy a put. Alberto would sell puts. H would go with a long call spread. Jamie would go long some puts. Okay. One more question. Now, don't worry about picking a specific expiry. I want you to pick days to expiration. So whatever you selected for buying or selling, again, you don't have to pick the actual expiration, but what duration would you target for your trade, buying or selling the calls or puts? Ben goes 0 DTE. Reese says 50. Alberto says 45 to 60. Paulo is behind. Hater says 20 to 30 days. Okay. So now, if we were to create a mapping for each trader, each of these questions that I've asked, there was some overlap, right? A lot of people said down, for example. But if we were to overlap the details of each response and map them and create a counter for the frequency that we select the same thing, it would be 0. We have the direction, we have the type of time frame we would want to trade the idea, we have whether we would buy or sell calls or puts, we have the days to expiration we would target for those calls or puts. So far, we have already introduced a series of literally vital variables that will be the difference between making money or losing money. A great example of this that sticks out to me is Ben's trade. Ben is talking about buying puts that are 0 DTE. What I can tell you is that depending on what the market does, there's a really good chance those will lose money. Now, whether or not they will lose money in the long run, that depends on the strategy. So now, let's go back and recenter ourselves on this idea of the outlier strategy process. And again, just a general trading process. It doesn't have to be this. It could be whatever you want. The point I'm making here is that based on all of those different ideas that we just discussed as a group for that series of people, the way that we would want to build an optimal position is completely different. And the only way we can figure out what the optimal idea is by studying things. So let's pick one. Let's use one as an example, and let's start by applying the outlier strategy process at a very high level. So I'm actually going to use Ben. One, because Ben has been helping us out in the Discord with the question of the day prepping. And also, I think Ben's trade is an interesting one. So if I go through the chat really quick, and I'm just going to compile Ben's answers. So we have down, we have a 1-day idea, we have buying a put, and we have 0 DTE for Ben. So those are the compilation to the questions I asked: direction, the duration of his idea, what the trade would be, and then the duration for the trade. So let's think about how we would build a trade around this idea. And I'm using this obviously as an example, and I will show you how to apply this process. So the first thing, the profit mechanism. In this example, we're using direction. And in this case, the direction is going to be to the downside. The type, we will have to see in a second what we want to qualify it as. But for a 0 DTE style trade in something like this is going to be primarily flow and sentiment driven. Meaning short-term inclusion of information is really what's going to drive markets in such a short-term time frame. Now, we already have now the profit mechanism defined. Now we need to think about some signals that help us identify this profit mechanism. So if we were to just spitball some ideas with respect to signals that are going to be relevant here, there are things like a VWAP. There are things like volume, support and resistance. And again, this is all for a very short-term time frame. We need to figure out a couple questions. We need to know what the robustness is of this 0 DTE directional idea. So we need to do a robustness check, and I'll show you some different ways you can go about this. We also need to qualify and quantify the effect. So something we can use for this, super simple. We can look at average volume. We can use the opening range breakout. Essentially, what does the first 15 minutes of the day look like? We can look at ATR, and more specifically for this case, ADR. We can look at price relative to VWAP, so on and so forth. What I'm doing is I'm saying, okay, if my idea here is to trade something short-term time frame, and I'm trying to figure out if there's some sort of trend I can identify with respect to the price movements of something in a very short-term time frame. So I'm thinking of different signals I can use to help me spot trend in a short-term time frame. And then I'm also trying to figure out ways to help me figure out what ultimately will make the most sense. Now, what most traders would instead do is they would say, I think it's going to go down, and then they would buy a random put. More often than not, they would pick the put at the price that they think it might hit, which is almost always the wrong answer, but that's what most would do. Instead, we are going to apply a little bit of analysis instead. Now, the next step that I typically would follow to explore this idea is I would come to a spot. Well, first, I would start with even something simpler, the eyeball test. I call it the eyeball test because it takes exactly very little effort, and it's to help me just look, literally just look and see what kind of sticks out to you. And a couple things really stick out to me right from the jump. The first thing is, in a longer term time frame, it's definitely uptrending. As I look at the distribution of candles between green and red, up day versus down day, I can see that it's sporadic and then also streaky. So that's an idea that I might want to explore. Meaning, is there some sort of concept or probability I can attempt to trade if the underlying is up 2 days in a row? So one of the things I would do is start writing these ideas down. Ideas. So the first thing can be next day persistence. based on prior day trend. And then I would just slowly explore this idea. Another key part of this process is if we're thinking about buying puts, we know we're in a race against time. And we also know that depending on what kind of price movement we want, the type of put we would buy looks different. So to illustrate this point, let's zoom into 6-month daily, and I'm going to go back in time. I'm going to take us to the 3rd of March. And I want to look at an example with you. I think this should let us go to March 3. Yeah, perfect. And we'll go towards the beginning of the day. We'll start it at 07:45. We'll see what the candle looks like there. Yeah, this looks okay. I'm just going to give you an example. Now, we already know this is a down day. I'm giving you, we already know the direction. So now, Ben, this is a specific question for you. What 0 DTE put trade am I doing? And I just also want to let Ben off the hook in the sense that Ben never said that this is what he would do. Ben is literally just answering the binary questions effectively I gave him. So I don't want the perception of like, this is Ben's idea and we're debunking it or exploring it. That's not it at all. We're literally just using it as a case study for the example here. So Ben, we know that for the example, we're going to trade 0 DTE options, and we're just picking a day that we know it goes down. So we know that we're going to trade some puts. So what now? Which one do we pick? You let me know as you look at this, and then I'm going to grab a drink. I'll be right back. We are sadly out of the mango orange, and we are on to lime, which will make work. We can get by with some lime. Ben says, I'm cheap. I don't want to pay. I don't want to min payment for put skew. 30 cents, I guess. Okay, so let's find 30 cents. 30 cents is right here. So we're buying a 2 delta, and it's going to be 32 cents. So this is one trade. I'm going to throw it in the analyze tab so that we can track these different ideas. You don't have to worry about what the graph looks like. I just want to track the numbers so that we don't forget them. So there's that one. Now let's take a look at a couple other ideas. Let's say maybe we grab something that's like a 50 delta, and I accidentally bought it. I accidentally sold this one. I got to buy this one. And I'm not worrying about cost yet. I'm literally just putting on single lots because I just want to compare relative movements. And then let's say that we want to get something that's super far in the money so that we're paying very little extrinsic value. So maybe something like this, the 60/20s. And then let's say, following Ben's idea, we want to go, I think he did a 2 delta. So maybe we'll go out of the money, but we'll pick something that's, a more common tail trade, which is like a 5 delta. So what I did is I literally have just grabbed a handful. And that lime is very good. And the goal here is I just want to help us come up with an understanding of the movement. So now let's go towards the end of the day. Market will close. Let's go to 12:45. And we'll say that we want to clean our trades out. Big down move. And rather than writing all of this out in my terrible handwriting, I will grab an Excel sheet so that we can explore the idea together. Now let's get rid of all this stuff. Okay, and then I need to get my little tablet out the way. So, let's start here. So we have, what's the easiest way to differentiate here? They're all the same DTE, so I'm not going to bother inputting this. I'm just going to put strike, delta, and then premium. And then we will look at exit premium. And then over here, we'll calculate cost. Then we'll calculate, and then we'll calculate ROIC. This is freezing up terrible. How do we, there we go. The game of these windows freezing is really annoying because in order to unfreeze it, I literally have to click in random windows. Sometimes it's OBS, sometimes it's the other browser window. I haven't figured out the pattern. So it's like super random. But let's just fill this in super fast. So we have the 5830s. We have the 5950s. We have the 6020s. And then we have the 5870s. And then I'm going to rewind us again really fast to 07 so that we can get the details from the beginning. Back up. I just don't remember what the deltas were for all of them. And then we'll also get the price, stock price. So what I'm showing you is literally a simple process that you can do yourself to even get a general idea of how we answer the question of what options make the most sense. And this is before we build a trade. This is the process of researching the structures. So if we go back for reference quickly, we're in this stage right here. We're outlining fitting structures. We're just eyeballing and testing some very basic ideas to see what might work. Okay, so right now in the example, SP 500 is at 5821.63. No, it's still uploading. Come on, man, you could do it. Right now, it still shows it as buffering. Let's see. $58. Yeah, this is still post the move. Dude, what is... I'll give this another couple seconds, and then if it dies on us, I will just guess. And the reason why I'm clicking all these random windows is because I don't know what's causing it to freeze right now. Okay, last attempt. We'll go out of on demand and then back in. Oh, it's like completely disconnected. Am I still on? Yeah, it looks like I'm still on. Oh, weird. It's showing Thinkorswim is completely disconnected. Okay. Well, I will simulate. And really the main thing I want to show you is pretty simple. So if it's frozen now. 5830. I just want to organize these fast. Cool. So now, if we just eyeball what these different things could be, again, I think Ben was like a 2 delta. This was like a 5 delta. I think this one was like a 50 delta. And then I think this was a 1 delta. Something like that. I think it's pretty close. And then the premium page, we know, Ben, you only wanted 30 cents. I think this will actually show us this is good, so we can at least see what the premium we paid were. So then we have this, we have $1.15, we have $13.40, and then we have $62.50. So we have all of this. So if we think about different size price moves, the total impact of the position will be completely different depending on how far the stock moves. Now, we'll start by just using delta. There will be other factors like implied volatility, but again, like because this is completely locked up, it's not really going to help us. And actually, to see if I can't fix it, what I'll do is I'll move us over to this screen. I'm just going to close it down really fast, see if I can't open it back up. Yeah, it's completely frozen. Very, very weird. Okay. So if we just use delta, it'll be close. It won't be as accurate as I want. So I'm trying to open Thinkorswim again right now. It says it's installing updates. So I'll give it a second to do that. And then if not, I'll just start guessing. So we know that this would have been about the stock price though, the 59.50. And then, because that's like a 50 delta. And then for the example, I'm just going to hop on my phone and then I'm going to see what the total movement was in SPX on the 3rd of March, which is what we're using. So let's go to the 3rd of March here. And it opened at 59.68. 59.68. And then it closed at 58.49. And it looks like Thinkorswim is down because it's stuck on installing update. So we'll just keep over here. So this minus this, divide by this. So this was our move on the day, 1.99%. So then we can just eyeball 58.49 is the exit. And then we can, again, we can guess what the premium might be based on just the changes in delta. So we'll simulate that now. Again, I just want to be abundantly clear. There are other factors. We're just using what we can right now because Thinkorswim is down. So the stock price here, then we'll do delta impact. And this isn't going to capture gamma, unfortunately. So the deltas, we're going to speculate that they move linearly, but they won't. So you're not going to capture one of the more, actually just realized that's going to be one of the more important effects, to be honest, is because the delta change on these based on gamma is a huge factor. So I won't be able to capture that because I don't know what the deltas are or what the gamma is for any of them. Damn it. Well, we'll see if Thinkorswim turns on later. If you guys can keep me apprised, if you don't mind trying it once in a while. And then in the meantime, I'll just summarize what we effectively know will happen. The first thing we know what will happen is that these two trades need much bigger moves in order to make money. But if we get those big moves because of gamma, they will compound very quickly. So then if we were to size these trades on a commensurate basis with the largest trade, which in this case is 62.5, what we can do is we can just eyeball what the lot sizes would be. So in this case, we're saying 62.5 is the cap. That's the most we can put on. So this is going to be a 1 lot. And then this equals the 62.5 divided by this. So this one you can get on a 4 lot. This one would equal the 62.5 divided by this. You can get a 54 lot. And then this one equals the 62.5 divided by this. You can get a 208 lot. And the reason for this is to show the example based on same size positions. Because here's effectively what would happen. In this scenario, we can see that for the more expensive position, you can't put on as many. But the bigger position will have a much higher delta. So then if you don't get as big of a move as you thought you might get, then all of a sudden, this one delta can make a lot of sense. So now let's go back. I'm going to just quit on Thinkorswim. And then let's go back. I'm going to grab, what's TradingView? We can use this for the example. And we were looking at SPX. And I don't have like the convenient indicators on like the same labels so I can eyeball ATR and ADR. So we'll just kind of talk about them in general. But here's one thing we can tell. More recently, look at the size of the candles here compared to the size of the candles here, compared to the size of the candles here, and then here, and so on. What do you notice? One of the things I notice for sure is that when it's going down, the candles are bigger. And then I notice when it's going up, the candles are smaller. Not every time, but in general. So the reason why this matters is because the way that I might build my trade, if I think it's going up versus if I think it's going down on the day, might also depend on where we are in a cycle. So in this case, I'm expecting smaller movements. If I'm trying to trade a 0 DTE idea, using those super far out of the money options is going to be very suboptimal because you're not going to get enough of a move in order for them to show a profit at the rate that they're decaying away. Whereas if I'm trying to trade the 0 DTE idea on one of these more inside days, maybe I go with the higher cost, higher delta. And it's because I get at least a dollar for dollar move with the underlying. So then conversely, if I'm trading up or down direction, but during these broader down move style days, the way that I build that position will look different because I know as the market's going down, the average daily range is expanding. That information impacts how I ultimately will build the trade. So now that we have at least a base understanding of how we test different structures to then create parameters around, this is when we turn option structures into strategies, then we can get into the trade process. And the process of building a trade is now very simple because using this example that we just did, if I know that I'm trading 0 DTE options with the directional tilt, and if I run my data analysis based on downloading historic data, and I take a look at what's the propensity for the third trading day after the prior 2 days were red. Maybe the same thing if the prior 2 days were green. And then I know that when the market is going down, the average true range is higher as compared to when it's going up. So in this example, going back to this, if we were trading one of these days in here, would I prefer, let's say we were trading it to the downside again. If I were trading this to the downside, would I prefer an in the money based position or an out of the money based position? I might prefer something that allows me to compound more. Or for me, I would actually take a hybrid, fortunately, because it's not really a this or that. Meaning the base position might be something that's in the money for the delta move, But then I might add a kicker options that are out of the money that will compound quickly if the move is large enough. I wouldn't do that if I was trying to trade directionally on one of these days. Now, this is also with the glory of hindsight, right? Seeing exactly what happens. But you'll notice as you analyze these things that this trend is very common, whereas things are going up and maintaining uptrends, the average daily range will contract, volatility will contract. That's exactly what that is. By knowing those details about the strategy, it inherently informs how I analyze the profit mechanism in the signal. These are details I know about the profit mechanism in the signal. So then when I'm building my trade, I'm building it in the context of understanding the broad performance of the strategy, and by understanding what the implications are, where we are today in the market against what my idea is, and then I build the trade that capitalizes on that idea. And again, this example was using like a 0 DTE concept. And again, to Ben's point earlier, it doesn't mean like that's not Ben's strategy. He was just responding to questions I had. Now, when we're going through and building a trade, one other note that's extremely important to identify, and again, this is all from the Outlier trade process video. You'll get all these details there. But the main thing is that it always, every single time, starts with reviewing the portfolio. The reason why we have to review the portfolio is because we need to know what the portfolio needs or doesn't need, what we want to put in or what we don't want. The portfolio fit is always the first stop before ever placing a trade. And there are different scenarios. Sometimes we'll look at the portfolio and there might be specific traits that we want to try to add to it. Sometimes we'll look at the portfolio and say, it doesn't really need anything. I just got to use more money. Or we can look at the portfolio and say, I don't really need to do anything right now. And in that case, you might choose to be super selective on what you might gain exposure to. So that's why portfolio fit is literally always first. So unfortunately, the platform is down. So I am gonna wrap up this session here. I'm happy to hang out for a little bit. We can do like a Q&A if you guys want to talk about what we just reviewed together. If there's specific elements that you want to explore, happy to discuss that stuff. Sorry that the platform kind of crapped out on us. A little bit of a bummer, but that's how it goes. The main thing is you really don't need the platform to understand the broader concepts that I'm explaining to you, at least hopefully. And the broad takeaway here is that when you're building a trade, it needs to start from the point of executing a strategy. The strategy has to be something that we've researched. Actually, we can do that really quick. We can talk about researching a strategy because with the platform down, I actually can show you another scenario. Actually, I kind of like that idea. What I want to show you is how to explore that idea that I was just outlining, specifically what's the propensity if there's 2 consecutive down days that the third day is up or down, right? Like that kind of thing. Now, normally I would use something very simple, like I would just use Python, but everybody now has access to ChatGPT, which is actually awesome because ChatGPT can accelerate all of that. So what I'm going to do now is go into SPX really fast on bar chart. And I'm going to go to historical data. So right now I am here and then I can just download it for the past, X period of time. And as you can tell, we download a lot of. So we'll grab this, open this up. First step, we just got to clean it super fast, get rid of this. And then the other thing that you'll learn from bar chart is that bar chart really, or I'm sorry, not bar chart, ChatGPT, it prefers date and then it prefers close. by changing those two, you just save yourself a little bit of training on the model. You can tell ChatGPT that it's named differently, but it'll get stuck up on it a little bit. So now what I'm going to do is I'm actually going to upload this to ChatGPT. And I'm going to tell it to analyze the performance of SPX using the last 5 years of data. I want to see if there is a predictive trend when there are 2 consecutive days of either an up or down move. And I'm going to define for it what I consider the up or down move. So this is going to be using open to close. I want to see if there's a predictive trend when there are 2 consecutive down days of either up or down. For the next trading day, and the propensity for it to either continue the trend or reverse it. Also, calculate the 20-day average daily range and see if there is a correlation between ADR and the third trading day continuation or reversal. And let's see what it does. So right now what I'm showing you is actually the process of researching it, how I would go about taking this idea and like just starting to at least get my bearings around it. Okay, so let's see. Brian says, are you a full-time trader? Depending on what you consider full-time, but I make the most money from trading, but I do a lot of other things. Ben says, oh, I thought I chose the puts specific for compounding, but I've never actually done anything with options. Yeah, no, that's okay. And that's those puts that you got, the way to look at it is that they're not all created equal. There are some puts that are much more susceptible to compounding. And then there are other puts that really don't compound as much, but just provide standard leverage. So a good example of that is if you buy an option that has a delta of 1, it doesn't compound at all. It's already at a 1 delta. The compounding effect of options occurs from gamma. So if I show you, we can get rid of all that nonsense. If I show you an option that has, let's call it a 0.10 delta. And then let's say gamma is 0.01. And then let's just fill this out like loosely. Let's say like 0.20. Let's say gamma is 0.02. Let's say 0.30. Gamma is 0.02, 0.40. And I think these are behind my head, so I'll move myself in a second. Let's say gamma goes to 0.03 and then so on. Give me 1 sec. I'll just move myself off to there. So this is one scenario compared to the other scenario where we have a delta of 1. Gamma will be goose eggs, 0. At least in your positive direction, just to be clear. Like technically this still absolutely can have gamma because delta in this context can change if it goes against you. But I'm just saying for the continuation, you can't gain any more delta. It's maxed out. So here's what happens. The stock goes up $1 plus 1. You go from 10 delta, you gain 10 cents of premium. You gain 1 delta, so now you have 0.11. And then this continues down the path. So then another scenario, if you have, let's say the underlying goes up another dollar, just pretending maybe this is super illiquid and this represents a $1 move. So now, well, there would be like 0.15 or something. I mean, so what ends up happening is as your option, as it moves in your favor, it compounds more quickly than just what the delta would provide. And it's because it's rapidly gaining more deltas as it goes in your favor. Whereas if you have an option with a delta of 1 and it continues to go in your favor, the most you can have is 1. So the compounding effect is all from gamma. Gamma is what allows your option to gain more deltas, and the gaining of more deltas per same 1 point move is what leads to the actual compounding effect. Whereas if we get something with a delta of 1, there really isn't much of a compounding effect because it's already at the biggest size, more or less, that it can be. But you have leverage still, because that leverage comes from the fact that even though that you have a delta of 1 and you can't gain more deltas, it absolutely is still cheaper to buy an option with a delta of 1 to control those 100 shares as compared to buying 100 shares outright. So, two different ways to play the same idea. Paulo says, generally speaking, does increased volume and or OI correspond to levels observed in price action? Generally speaking, depends on how generally speaking. If I were to do my best to give you an answer that isn't, it depends, I would say a low correlation, but it depends. And it's because there are certain things that there will be a significant correlation. And then there will be other things where there's very little correlation. So it genuinely does depend quite a lot. Now let's see what ChatGPT came back with. The file and data processing was interrupted. Please upload the file again. Okay. Do your thing. Oh, I don't know if you guys have tried GPT 4.5. It seems okay, but I think for this 4.0 will be better. So I'm letting that run in the background. Let me grab the chat and then hang out with you guys while it's trying to figure its life out. Any other questions that you guys have, either on what we've covered so far in the series or on what we've covered tonight while this is running? Alberto says, this has been a fun session. That's awesome. Yeah, I'm glad. I hope that it's been at least useful to understand the process, because that part is super, super important. ChatGPT is saying it seems the file doesn't have a column named time. Oh, this is funny because I already trained the model on the old version. That's so funny. Time column is now date, and last column is now close. That's so funny. In this chat thread that I have with it, I trained it to the old columns and it remembered it. The humor in that's pretty good. Let's see what this comes up with. Now, the other thing is you can do this in Python. Ah, perfect. Here we go. Okay. And this is exactly why ChatGPT is the fucking game changer. This is exactly why. So the question we started with is there any sort of predictive value in 2 consecutive trading days, whether up or down, and whether or not that impacts the third day? And this goes back to the original idea that we were talking about for Ben for trading 0 DTE directionally. And we have to figure out some sort of predictive capacity to identify direction. So we downloaded the last 25 years of data for SPX daily. We asked it to run the analysis on the last 5 years. And again, I would take this research much further. I would segment it. I would weight it towards the more recent data. I would use a longer look back window, but it's really just for the sake of the example here. And this is what ChatGPT gave us. It gives us the actual output of data. And it says that in the scenarios, the probability of a trend continuation after 2 consecutive up days, 51% chance the next day is up, 48 that it's down. The probability of a trend continuation after 2 consecutive down days, 55% reversal, 44% continuation. So what do we notice? We notice 2 very usable ideas. The first idea is that there is a slight edge for reversal in both scenarios. The second thing we identify is that the probability of a reversal is larger on down days than up days, 2 consecutive down days turning into up. It's a 4-point edge. That's pretty significant. Now, there are further questions we could ask to refine this. You can see that the correlation between the 20-day average daily range and third consecutive continuation is about null. It's insignificant. So then we can ask other questions though. We can say, is there a relationship between the 5-day ADR and maybe the 20-day compared to the 5-day ADR? Or maybe the price direction for the first 15 minutes of the day compared to the close? Or the size of the prior move as individual days or composite days? All these different questions are ways that then we can analyze, and this all is tied to step number 2. But all of this then continues to help inform our ideas. So a follow-on question I would ask, and let's see what it has, is for each scenario, what is the average percent move on the third day? So now I'm essentially saying and wanting to see is there a meaningful difference between the size of the move in these 2 scenarios? So after 2 days, the average, after 2 up days, the average third day move is negative 0.016. So on an average, besides the count, it means that the down moves on the third day are larger than the up moves, right? That's how it builds that negative skew. And then after 2 down days, there's a positive 0.078% average move to the upside. So what that would infer then is that there's absolutely a more significant effect to the rebound versus a third continuation down day. All tradable information. This is the fun part of trading to me. I don't know if this is stuff that you guys are like, yeah, this sucks. But for me, this is like the ability to just explore ideas like this and then to figure out how to monetize them is so fun. That's one of the big things I'm actually about to work on a video right now that's talking about a recent change that I've seen in 0 DTE options. And I'm excited to launch that. It won't be out, honestly, for like a month because I'm building out the videos. I'm traveling a bit. I'm hitting up Ireland next month. So I like to try to have videos queued up for you guys so that you're still busy. But Ben says, do we see that in option press? Calls going up on 2 days down? I don't follow. Could you help me understand better? Premium. Well, think of it this way, right? You would have to break that out then into 2 follow-on questions. The first primary input in this context is going to be volatility. So is there a demonstrable volatility edge? delta change. And in this case, we know that if the market's going down 2 days in a row, volatility is more likely to be expanding than contracting, especially when compared to 2 consecutive up days. Volatility will typically contract versus expand. So that will impact the price correspondingly. And then the severity of the move would be the second input in terms of option premiums. So what you'll notice at a high level, and again, that's a great question, by the way, but the way that you would chase that down subsequently is then creating like a 20-day and a 10-day rolling volatility input for the model, which is, again, super easy to do. ChatGPT can do it for you, or you can do it in Python, and you can analyze if volatility is expanding, because if it is, then you know the options are getting more expensive. I was just going to try to click into the platform. I forgot it's closed to show you the change in implied volatility, but that is what you will find. Sweet. All right, gang. That wraps me up. 2 episodes left. If there's anything that you need, if you're stuck on anything that we've learned so far, let your boy know. But as always, be an outlier. I'll see y'all later.